Good evening. My name is George Sarah-Nicolau. I am a faculty advisor in the Capstone Workshop course, and I also coordinate the program. Welcome to tonight's final briefings of the Capstone Workshop in Integrative Sustainability Management. This is a very special course in the Sustainability Management program for a few reasons. The most important of which is that it provides an opportunity to students to work on a real project for a client in either the public sector or the non-governmental sector. These projects allow the students to draw from the knowledge that they've gained in the program and from their own job experience to solve very important sustainability problems, answer key questions for the organizations that engage us, as you will see from the presentations tonight. So students draw from the various parts of the curriculum to solve these problems and answer these questions. They draw on the management component, the public policy, the financial management, the economics and quantitative analysis, and from what we call the physical dimensions of sustainability. And so you will see components of these parts of the curriculum in each of these presentations. The course is also special because it comes at the end or near the end of students' course of study. And so tonight is something of a graduation party for the students. So it's in that spirit that we will celebrate your accomplishments. To the presenters, it may not feel like a presentation or a celebration, until the end of their presentation, but it is a celebration. So tonight we will hear 5 presentations on 5 projects. Each presentation will be 10 minutes. At the end of each presentation, I will moderate a very short question and answer period. We'll then take a break. There'll be more cheese and crackers in the back. And then we'll set up the next presentation, and I'll call you back to your seats, and we'll do that for the next 2 hours or so. So with that, I'd like to have our first presenter. The faculty advisor for this project was Professor Jessica Prata. So Divya, please.
Good evening. My name is Divya, and I'm excited to share a snapshot of our capstone team's work. Our project investigated the role of pension funds in a transition to a sustainable low-carbon economy. In the next 10 minutes, I will share highlights on what leading pension funds are doing in this space. But first, let's talk about our clients, the Organization for Economic Cooperation and Development, OECD, and Mercer. So, what does a development cooperation organization and an investment consulting firm have in common? If you guessed climate change, you are right. Climate change is not just an environmental issue. It is an investment issue, and it is a development issue. Our clients have a shared interest in helping institutional investors address the climate change finance challenge. So, what is this challenge? We need to make a significant shift in the way we are allocating our investments to certain economic sectors. This chart shows the IPCC's estimates in changes in global investment flows that are needed in the future to meet a 2-degree change goal. As you can see, we need to reallocate our investments from the carbon-intensive sectors to the low-carbon and carbon-neutral sectors. So who is going to drive this investment change? We looked at the World Economic Forum's data on the global capital pool. As you can see, pension funds control nearly half of the world's investable assets. So this is where the change needs to happen. Pension funds also have a financial imperative to act. They have long-term investment horizons, and they have global portfolios that include fossil fuel and other carbon-intensive firms. So climate change poses a significant risk to the financial health of pension funds. Pension funds are also well suited to act because they have an interest in promoting economic stability, and they have a fiduciary responsibility to align investments with their beneficiaries' interests. However, most pension funds are still a long way away from addressing these climate risks. This chart here shows data from the nonprofit Asset Owners Disclosure Project. It ranks the pension funds on 5 climate change-related criteria. And as you can see, most of the pension funds received D and C ratings. But there are pension funds that received A ratings. And our clients have asked us to study initiatives from such leading pension funds and then aggregate the best practices. To identify best practices, we interviewed investment managers at leading pension funds and spoke to experts from the consulting and advocacy world. We also reviewed published data and studied financial reports and surveys. Our project puts together a framework that addresses 2 issues. The first is how pension funds can develop an internal apparatus to set themselves up to act on climate change. And secondly, it provides a holistic approach through which pension funds can act on engagement, advocacy, and asset allocation fronts. After studying over 30 pension funds, we've developed detailed case studies on 3 pension funds from 3 different jurisdictions and different asset bases. In the next couple of minutes, I will share highlights from some of these best practices. And later, I'll give you a quick walkthrough on one of our case studies. So first, let's talk about the internal change management. The idea of addressing climate change risks is still very new for most pension funds, and pension funds have been spurred to action by various internal and external triggers. These include mandates from board and management, weaknesses exposed by the financial crisis, regulation, especially in Europe, and a growing awareness of climate change risks. To address these climate risks and mandates, leading pension funds have developed internal policies, teams, and processes that build buy-in and internal expertise. For example, CaISTRS studies ESG, environmental, social, and governance issues associated with investment through its Sustainable Investing Research Initiative. It's almost like an internal think tank. Other pension funds build ground-level and board-level ownership through policy statements, training programs, and board subcommittees. Now, pension funds can move large amounts of capital through their portfolios, but let's not forget that they also wield immense influence on policymakers, corporations, and on the financial services industry. Leading pension funds collaborate with each other and with other advocacy organizations to develop tools and standards to advance sustainable investing. For example, 3 pension funds worked with a university to develop the Global Real Estate Sustainability Benchmark, a green real estate rating system. Other pension funds are now going beyond governance, and they're engaging with companies and policymakers on climate change issues such as carbon asset risk. Pension funds can make a significant impact by identifying low carbon investments and then preferentially investing in them. There are 5 asset classes that pension funds are already investing in this area: green real estate, green infrastructure such as renewable energy, green bonds, low carbon listed equities, and forestry and farmland. Our project identifies specific strategies that pension funds have used to achieve competitive returns without compromising environmental performance. For example, the French fund ERAF's sustainable equity portfolio was 19% less carbon intensive than the global benchmark in 2013. Now I'm going to give you a quick walkthrough of one of our case studies. The California State Teachers Retirement System, CaISTRS, provides retirement benefits to about 800,000 Californian educators and has approximately $190 billion in assets under management. It was one of the early movers in the sustainable investing space, and its climate change initiatives can be traced back to directives from its board in 2004. External triggers, such as research on carbon asset risk and advocacy from beneficiaries, has also been a factor. CaISTRS has also put in a lot of effort in integrating climate change within investment decision-making. Its Green Initiative Task Force implements its sustainable investing strategies and is comprised of senior portfolio managers from all of its major asset classes. Since 2010, CaISTRS has been polling external managers on how they're integrating climate change in their own investments. And lastly, CaISTRS has a formal list of 21 ESG risk factors, including climate change, and it has integrated these risk factors within investment policies for each of its asset classes. CaISTRS is also an outspoken advocate on the engagement front, and its sustainable investment portfolios have outperformed global benchmarks. It has also committed to increase its green infrastructure investments by 150% to $3.7 billion in the next 5 years. Now, all of the information that I've presented in this case study and some of the best practices I've shared with you was in the public domain. However, it was fragmented across a range of pension fund documents, financial reports, press releases, etc. Our project brings together all of this fragmented information within one cohesive action framework that is useful for any pension fund at any stage in its climate change integration journey. Our framework addresses 2 factors: internal strategies to build an apparatus for addressing climate change, and external strategies for acting on climate change through advocacy, engagement, and low-carbon investments. Our clients can use this framework to meaningfully engage with policymakers and pension funds. It can also be a starting point for some of their thought leadership work in the future. However, to move to a low-carbon economy, we also need service providers to develop low-cost investment vehicles and tools for measuring carbon impact. And lastly, we need engagement and advocacy. Pension fund beneficiaries, you and I, must insist that our money is invested sustainably. And with that, I've come to an end of my presentation. I'm happy to take questions.